Welcome back, everybody, to Real Assets with Jimmy. Today is January 26th, 2023, and today is D+1 of Tesla earnings. Highly anticipated. Jimmy and I both were watching that yesterday, and so a couple things to talk about today. I wanted to get into talk about some real assets. Whether mortgage REITs are real assets or not, I think is probably that's I guess a question in and of itself. But let's start before we can get into mortgage REITs and real assets and all that. Let's talk about Tesla. Not it is an asset. How real it is up for debate. But gapping up today, 18% this week. Today we're up 9%, but actually lower than we've given up a little bit from the open. Hasn't crossed below its VWAP yet. That actually could be fun to watch if it does, especially if the market kind of sold off into the close or something. But so far that these sounds like a lot of hopium from a Tesla kind of bear, I guess you would say. But anyway, Jimmy, what's did you have any takeaways from the Tesla earnings, or what did you think about that?
Good morning, Turtle. Good
Good
to
morning.
talk to you again.
Yeah, good to talk to you.
The market said F my Tesla short. That's what it said.
Yeah.
I didn't load up, but I dabbled in at the end of the day yesterday, and clearly it's better to cover today.
The price was
I
wrong.
actually shorted some more. Yeah, the price was wrong. I shorted more around 158, so it's been holding this general area. And that first chart you showed, if you zoom all the way back, there's
Go back to the weeklies, yeah.
Yeah, back to the weeklies before it made that big run up. It's kind of has on this like little shelf here at this level. So it's the company reported. I don't think there were any major surprises. 2022 was a good year for the company. They continued to grow. They continue to expand their business, the macro headwinds and capital markets aside. But it's, I guess the funniest thing is I was talking to a client, someone I was working with, he was like doubling, tripling down into Tesla in November, December. I mean, he's been hurting. He's seen the value of the shares drop by about 2/3 in the last 3 months. So that's no fun. When I ask him, what is the bull thesis? And I start going fundamental investor on him, talking about fundamental ratios with other automakers and this and that. He's like, I don't think about it as an auto company. This is a tech company. And I hear that line a lot. So there was a time and place in a market cycle where that type of narrative driven thinking was attractive. It drove in new inflows, it drew in new interest. And I continue to find that whether it's Tesla, whether it's a lot of these other fallen tech stocks that had meteoric rises to, bubblish valuations, no doubt, and now have kind of come crashing back down, that a lot of that bullish narrative dies hard. The price action has already disconfirmed all of that. Short squeezes and short-term trading aside, it's quite clear that Tesla and many, many other high-flying growth companies are going to face a tougher challenge in 2023. It's harder to grow auto sales when just when auto interest rates are up. When the buyers of a lot of these Tesla cars that were tech enthusiasts are seeing their net worth decline, when GDP is going negative 3% year over year versus, plus 2% year over year. So there are all these headwinds, and that's the setup. It's not new news, but here we are, right?
No, yeah, I think the point about the enthusiasm dying hard is so key, especially, that's the kind of the ultimate retail shareholder base. That, I mean, there's no better example of one that people are, they own the car, they're long the stock, and it's kind of like a feedback loop. And to your point, that's gonna
maybe AMC.
Yeah, maybe AMC,
swag, buying.
Yeah, but to your point about dying hard, it's just hard to go. It's hard to see somebody that's kind of levered into that position just reversing or under, kind of waking up all of a sudden. And especially when you're up, you're still up, depending on when you came into the story, you still could be up big. And this chart I think does a good job of showing that, right? I mean, we've got a long way to go. We could get cut in a third from here, and you're still, back to COVID levels, to pre-COVID levels. And the real assets we're talking about, we're just trying to get back. We would love to get back to pre-COVID levels.
Yeah. Yeah.
So it's so there's the enthusiasm to your point. I think dying hard is just kind of a key word there, and I think saw Jim Chanos going back and forth with Anons on Twitter, and like, not that they represent the whole long shareholder base, but definitely they're representative, and it's to your point, it's not a car company, but all the revenues come from cars. So you can, it's almost funny kind of listening to I shouldn't say almost funny, but the conference call itself is an experience, right? It's not a traditional Wall Street conference call. Did you listen to any of that from last night, or?
I actually did not.
Yeah.
I did read really? The earnings report, but yeah, honestly, it's yeah, who cares?
Yeah,
right. And what's funny is, like, when these names drop so precipitously like they have, this is also brownie emotion to some degree. You do need a passage of time to fully figure out what's happening, and again, if you're the technical analyst, it's trying to hit that, I guess it was a November top. This is separate. This is NASDAQ.
Yeah,
right?
it's cute. I mean, it's the same chart, but less levered, I
guess. Someone saying it's waiting to break out. It's at the 200-day moving average.
Yeah, exactly. No, exactly.
I don't see it. I don't see it the same way, but
right. And I heard a guy say on Spaces, this made a lot of sense to me, was people keep asking, like, can the NASDAQ, can the Qs hit 300? Can Tesla get back to 200, whatever level you want to talk about, or it's or like you said, a moving average, and of course it can, but the question this guy was talking to bulls, but he's saying the question you really should be asking is, can it stay there, right? And that's kind of where, and now, again, anything can happen. I don't have the answers to the future, but I think that's the tricky part. I'm short the shares personally, long a little TSLQ personally, and comfortable with it. Less comfortable this morning, but much less comfortable, but still comfortable with it. Enough on that. And so that's just to bait the people in. Let's get to where the real expertise of the show is. Jimmy talking about the real assets. So I put this on Twitter last week. This was the Turtles REIT kind of watch list. Just some stuff I'm looking at. Who cares, really? In the top three sectors, housing, net leases and mortgage REITs, like we talked about, all three of them like rates going down. But mortgage REITs are extremely levered to that, right? As you mentioned yesterday, why are rates coming down, right? I guess that's one component, right? If Jerome Powell is furiously slashing interest rates because a comet is heading for the country or for the world, then that's probably not the best thing for mortgage REITs. However, in general, that's been a big, if we look at the chart, let's go back to our chart here. If you look at the chart of mortgage, here's an ETF from Van Eck of mortgage REITs. You can see that these things have been steeply discounted since COVID, but then especially also since they've got discounted again. You got the 20% off when rates started going up. So what I wanted to see, maybe I could just kind of pick your brain. I thought that would be kind of the opportunity here is
would love to.
Yeah. So maybe just like a little, to start with like a little primer and kind of your experience with them, and maybe just, and then here's really, so your experience, a primer, and then really the last thing is like, these agency REITs, right? These guys own high quality paper backed by Fannie and Freddie. These things are pretty beaten up. Like, is there what are we looking for before we get our beak wet a little bit, Jamie? What do you think? So the floor is yours.
I suppose that the framework to view mortgage REITs has remained stable over time, although I think new competitor products have come in and different, I think the subsector of not just retail investors who look at the yield, but maybe more on the institutional front who are deploying capital to the space. Um, have looked at these in a couple different ways. So one is kind of the fundamental analysis to see what is the underlying piece of paper they own. It could be a bridge loan. It could be a piece of CMBS. It could be a more senior position, like a first loan, secured loan for a property. And then, of course, you've got the floating rate versus the fixed rate component. A lot of senior loans and other more traditional type loans are fixed, whereas a lot of the bridge financing, mezzanine debt, higher yielding, higher risk type of paper has a floating component to it, or it's typically, just high enough where and high and short enough from a duration perspective, right? If you're lending to a developer and they're looking for bridge financing, that's a 2 or 3 year type of duration. And the
Right.
idea is that once they've developed the property, they can get more permanent financing, and you make a little chunk of change for helping them bridge that gap. So there's the underlying, analysis of the paper that they're actually invested in, which has its own supply demand, liquidity dynamics, and institutional versus retail dynamics, mostly institutional, and a lot of government, like you've mentioned. If they've got Fannie and Freddie, they've got agency loans. Presumably, the government has some type of bid as a last resort,
Mhm.
or there's just a steady volume of that paper moving. Although, you look at these guys, they don't typically, the REIT itself, the mortgage REIT itself, is not trading that paper. It's typically bought, held to maturity, or there's some type of portfolio management, but it's not active.
Gotcha.
Um, then for me, the more real estate related aspect is what is the quality of the underlying asset
Mhm.
that the paper is secured on, right? So you've got the paper, you've got your investment dynamics. I guess it is like equity, right? It's like what is
Right.
the equity supply and the equity liquidity, and then what is the underlying company doing? So what is the underlying piece of real estate doing?
Mhm.
How does it compare from, how does the private market for that real estate um, compare over the last few years? How does the financing environment look over the last few years? How does the um, outlook for, let's say, leases and market rents and all the real estate components of it? Where's that trending? Um, and then finally, for me, is kind of more of the pure factor exposure. So the REITs themselves, the mortgage REITs themselves, how do they trade? How are they affected by interest rates? We talked about
Mhm.
sensitivity. How are they affected by their different factor exposures that are driving risk on or periods of risk off? So
Mhm.
it's kind of a three-pronged approach. And there are times where, something is more dominant than the other. Clearly, when liquidity dried up and the Fed had to come in March of 2020, there was no bid, even though the real estate presumably was, stuck in limbo, but some of that is slow to reflect, whereas the prices are quickly to reflect. But today, at the beginning of the year, it's always interesting to pontificate about the state of the market, the state of real estate, the state of all this stuff. So let's dive in. Let's take a look.
I love
Let's
it.
answer some questions.
Yeah, and
Yeah.
what an opportunity to be able to pick a brain. So back in your day, when you sat in the seat, you covered these as well, or is that typically a different guy that covers equity REITs and mortgage REITs?
Many of these mortgage REITs were not included in the FTSE EPRA Nareit index. So over time, the institutional investor, the pension fund, the 401k plan, the institutional consultant that is driving that allocation have fought for more of a core real estate index because of, you mentioned there's so many different types of companies that get the tax treatment to be a REIT.
Right.
And it's in this cycle, we've seen the rise in institutionalization of newer asset classes away from the traditional, multifamily, office, industrial, shopping, some of those key food groups. We've seen storage, we've seen data centers, right? We've seen triple net, senior housing. There's all these other kind of new players to the party. But mortgage REITs typically were not included. I'm sure there's a couple of indices where they are part of a broader ETF, but certainly for many of the institutional players, they don't screen right away. They're not
Right.
in people's minds.
Right. So, and then, but just, I guess clarifying one thing you were saying makes a lot of sense, and that's a good, or one thing to clarify is like, so these guys, for example, like these, so more MORT, the ETF, the top holdings would be your big agency REITs, right? NLY, AGNC, and so those guys are tell me I'm wrong. Those are pure play mortgage REITs. Like they just own agencies. They don't own any actual buildings. They don't actually own any equity. But there are a lot of like hybrid REITs that own both. Yeah. Is that where am I wrong there? Or what's wrong with that statement?
No, that's correct. And again, we would have to look into the company filings and the supplementals just to confirm that. Right. But in principle and in practice, that's how these companies are structured. Yeah.
So what's interesting to me, and so why somebody who doesn't, I don't traffic in these, like my clients don't own them. It's not something that I own a lot of, or actually I don't own one share of any of these currently, but I am interested for a couple of reasons. There's a guy on Twitter, Special Sits Report. He recently, I subscribed to some of the stuff. He recently wrote up TWO. So shout out Special Sits. I think he does good work. And I think he had some good research on TWO, which is really beat up, right? It's kind of like skating near its, it's much closer to its COVID lows than it is to its PWO. Now, that's not a reason to do anything. That's just a point. But what I think is interesting, and so why these would be interesting to me was kind of 2 points here. One is the fact that we are basically, these bonds that are, or excuse me, these pools are backed by Fannie and Freddie. They're trading at 80 cents on the dollar. And if they were to default, that would be great because we would get $1 back, right? And so I think that kind of rates coming back, the leverage you would get if rates came back down, that pure play that they just own these agency REITs, that's what I thought was interesting. And then the second part of that is, here's a little write-up on Global X. I guess they have a couple, I don't know if they have a mortgage REIT fund, but they have a couple high dividend funds that own a bunch of mortgage REITs. It's this interest spread component. And so these things, basically, my understanding is trade on an interest spread. And excuse me, this is not the slide I was looking for, but they basically, so the spread between your average 30-year mortgage and the 10-year treasury, those spreads have never been higher. They're kind of blown out. And so those spreads were to revert to a more normalized level, then we could, you might see some recovery in the share price of these agency REITs. But one problem with that is, I'm looking for this. I had this chart on spread somewhere in here. Oh, you know where one's in? It's in this, one is in this slide. What slide is it? Here, find it in here. But so point being is that I mean, so if those spreads were to compress, we can make some money on these, or one could potentially recover, make some money on that. But I don't know. Do you have any insight into that? I mean, here it is, right here. It's the first page, and this is I believe one of the first pages. Oh, page 7 of their deck. But so historical agency MBS spreads, right? And so there you go. That's what I was trying to say. So our spreads are now above 08, which I believe, you tell me, you're the, you know someone who would know. That's basically just a function of pressure in the mortgage system, right?
That's right. Yeah. And just FYI, what period was this presentation
Is
done in? Is this for the
last
third quarter?
Yeah, this is, they don't have their fourth quarter presentation posted. So this was
Right. Right.
uh yeah, so I believe this was like a
Mhm.
November presentation.
Yeah.
Here we go.
I think
Daily spreads to 10/19/2022.
1019, right. So it's funny because we talked about how the dollar peaked at that time and how since 1019, if you were to look at this chart, um, since then the 10 years come in probably at least 50 basis points.
Right.
So you might think that the spread would be even wider from this period on. But
Right.
I think many of our viewers are savvy enough to understand the relationship between credit risk and yield spreads, and they can resolve themselves in a couple different ways. If something goes belly up and you get a non-payment, your spread goes from yielding 20% to yielding zero. So there's a lot of ways for credit spreads to narrow over time. Clearly, when there are periods of complete capital market dislocation and spade could reflect a very outsized, three standard deviation type of spread. I don't know that that necessarily is indicative of any buying opportunity. Again, I think it would be much more, I think one of the things that we talked about is how do these companies trade at the beginning of a cycle, in the middle of a cycle, and at the end of the cycle? So, and how useful are these historical relationships in these periods of time? I mean, I think it's very clear that in the situation we face today, just pointing out to a spread blowing out and saying this is an entry point is a little bit unidimensional without acknowledging the underlying risks.
Man, how much money did you just
But
save my
again,
family with that one line? No, that makes a lot of sense. So
yeah,
but and also another thing about that is it's too bad, and this is just like being retail and cheap. Like I can't even track that data series. Like I don't even know. I mean, I guess you could track the 30-year mortgage every day and you subtract out the 10-year treasury, right? It's not rocket science. But it's too bad that like TradingView doesn't have anything. I couldn't find anything that like tracks it, right? It's not an easy to track
no,
series. Is that? I mean, it's just I guess it
yeah.
didn't. MBS spreads is not something that most retail guys even care about, I guess.
But what's interesting is you mentioned, you've got bonds trading at 8 cents on the dollar. Like if you
I said
really
80,
wanted
80, sorry.
to, oh, 80. Okay, so if it's trading at 80, it could go a lot further down. But the idea is because these companies are so many layers removed, right? They are collecting a bond payment for an underlying asset, and then they themselves are producing a certain dividend yield with leverage at the corporate level to juice that underlying payment frequently. That's how you get these double digit yields. So I think the more philosophical question is, are if we think there is an inflection point or if we think there's an opportunity, is our mortgage REITs the best way to express that view? Presumably there will be, if someone's not trying to arb what the mortgage REIT holds at the underlying level versus where the mortgage REIT is trading at and the implied valuation of its holdings, right? Because implied valuations can imply a lot of things. It can imply impairment at the underlying asset level, or it could just imply a lot of no demand at the stock level, and you don't know what the market is trying to guess at when it comes to underlying paper. So when the time comes, maybe it's more worth it to be buying some notes that are trading at 40 cents on the dollar, going to 60 or going to 70 than it is trying to in size, commit to mortgage REITs going in or out. And I got to think it's similar sets. These companies, track high yield with a lot more beta.
Yeah.
And presumably, if the market were to recover from here, you would see something similar.
Yeah. Right.
Just
And
Two
no,
Harbors, I think, is off. It's up 100% from the last couple months, right?
Two Harbors. Yeah, it's bounced up. Well, yeah, it's bounced up nicely. Yeah, sure, sure. You got
At least 50
you're up
from since.
50%. Yeah, yeah. And one thing, no, that makes a lot of sense. And honestly, the biggest thing I heard was just it's just there's a lot that it's just probably um not a great place to park capital for retail unless you like really know what you're doing. Because like what are you getting? And you know, one thing I like to do actually is just look at long-term charts. And obviously you're getting a fat dividend here. So that needs to be, you probably should be looking at total return and not just price. But
It's
one
also,
thing,
if you think about it, it's a levered dividend.
right.
One of the things that people really don't fully understand, and again, mortgage REITs have a heavy retail ownership component. You don't see as much institutional capital in the space,
Interesting.
but
Yeah.
the company might be the company might say, hey, we've got these very high quality, first tranche senior secured loans for a commercial property that's well trafficked, in a decent MSA, top 30 MSA. It's something that you think would have a bid, right? So they are charging, let's say, 4 or 5%, because this was issued a while ago, right? It's from 17, 18. So they've got this 4 or 5% piece of senior paper that they hold, but then the mortgage REIT itself is levered, particularly with the stock price drops. There's kind of leverage on a how should I say this? This is a little bit more real estate specific, but there's leverage on a more NAV neutral basis, so at book value, and then there's implied leverage based on where these companies are trading. So if a company is down 20%, is trading at a discount, even though it might not be levered at book value, the effective market leverage is a lot higher, right? Kind of like a lot of these small caps that are down 90%, and all of a sudden what felt like a small amount of debt is now a massive amount of debt. So in order to juice the yields and juice their dividends, they were taking, if you think about the low interest rate environment we found ourselves in for the last several years, they were trying to get a little extra squeeze from the paper that was not getting a lot of return for the risk. So just caution. And so now that the companies have gone down, obviously the dividend yields have increased,
Right.
but the quality of that underlying payment clearly has diminished,
Yeah.
and it's not, and so it's a little tricky, right?
Well, no, it's a lot tricky, and especially it's a little tricky to you. It's a lot tricky. No, that makes
I'll
a
just
ton
say
of
one
sense.
more thing, because
Yeah.
there's a lot of nefarious activity. Um,
Right.
when the CMBS market was open,
Yeah.
and particularly for properties in the hotel sector, in a lot of these other more pro-cyclical sectors, and there was mezzanine debt financing,
Yeah.
these companies were getting north of, at the time it was like 8.5, and that was considered like an all-time low yield, like bridge financing from 75% LTV to 85% LTV. So the equity guys only had 15% in a project, right?
Yeah.
Because terms are so cheap, companies were lending the first 70% in a zero interest rate environment at 3.5,
Yeah.
particularly for a bridge loan, right? Something that they felt like they could get out of without holding on to that bag. And so if you're a developer and I can get 60, 70% at 3, the
Right.
math to me works that rather than putting up 30% equity, let me put up like 10% equity. I'll gladly pay 10% cost of debt on the next 15, 20% of the value, because my ROE is so sky high and I'm going to cash out as soon as I can. So there was a lot of gamesmanship played. And so like what these mortgage REITs would do is that like they would obviously go for a lot of the junkier, higher yield stuff that was yielding 8, 9, 10, 11, 12%. And then and they wouldn't lever, they would say, this is kind of financial engineering at its finest. The CFO would
Yeah.
say, here's our corporate balance sheet. We have secured, so we have our underlying assets are debt paper with their own leverage, right? But at the corporate level, we have borrowed on an unsecured basis, or we have borrowed at a secure basis. So they were able to break down their leverage and say, hey, for our first lien senior secured loans yielding 4%, we feel comfortable enough to tack on additional debt at our corporate level secured by this paper to double that yield. You know what I'm saying? To
Yeah.
get 8% on that percent piece of paper, it's like someone levering up to buy bonds,
Right.
trying to get a carry trade. But for the more risky part that was yielding 10% or plus, oh, we don't have any leverage on that. We're being prudent. This is like, right? There's no pass through leverage. And so you would get to these blended target levels where these companies, even in the middle of the cycle, effectively they were 70 or 80% levered.
Right.
Because
right.
they were in 50%, 60% positioning paper, and then they were adding another 30% on the corporate level to that.
No. Yeah. And I think, there's such a psychological component with dividends that people love dividends. I mean, look, the first thing you said that really should got my red flag up was like, look, if it's not, if institutions don't play there and retail does, okay, like we're talking about it's like the variable annuity market or something. It's like, why, that's a product that's sold, not bought, generally speaking. And maybe you could say the same thing about potentially some REITs potentially. But the other thing, and again, dividend component is totally different. AGNC on their, I believe their first page, they talk about, how much they've paid out in dividends. Here you go. They IPO'd in 2008 and they've, at $20 a share, and they've paid out $45 a share since. But that said, I mean, the stock's at what today? It's an $11 stock, right? So now you've made your money in dividends. Sure, that's great. But the point is that this has really not been this hasn't been a compounder. Let's just say that. And
no, it's not a total return vehicle for sure.
It's not a total return vehicle. And people psychologically are attracted to dividends. And so if and there's these guys on Twitter and on Seeking Alpha, they're, get rich and retire off dividends. And a 12% dividend makes that math pretty easy. But there's a reason it's a 12% dividend, and because you ain't going to get it.
And again, for our viewers, there's so many different levels to the game.
Yeah.
But even just one step above the basic level is like, if you think about, it's not a company that has underlying buildings that they've held over time. Right. It's a company that has a rotating book of debt. It's a creditor. So there's duration that's coming in and out of the portfolio. There's reinvestment risk as loans expire and they have to originate new loans in the new capital market environment at a different yield. So the company that AGNC or that any of these mortgage REITs were 10 years ago, 5 years ago, is drastically different than it is today, just by nature of what's actually in the portfolio. So it's almost like philosophically, you don't have a conjoined time series to even think about total return.
Right. You could maybe invest in a management team or something, but
sure,
it sounds like. But
and they're trying to prove that, right? They're trying to say that in the course of our history, the price of our stock be damned. In terms of the cash on cash generation, we've provided enough yield, and maybe that's the thinking, to compensate for the inherent risk in the business model.
Right. No, that makes sense. Basically back to the core idea here, and then maybe I'll hit you with another question if it's all right, if you got time.
Sure.
So the kind of no, that makes a lot of sense. And so it doesn't sound, back to our chart here. So honestly, just picking your brain for a few minutes, a little less interested in MORT and its components. Back to this chart here. However, back to Joe's bridge bands, Joe Catanzaro, creator of the bridge band, was so kind to make public. the 10-year is now a bearish trend, right? If you're using a daily look or a daily bar. And so now, so point being, let's look at this chart here. We've looked at it before. We'll look at it again. And, throughout history, kind of like, mortgage REITs, Chinese stocks, nobody's ever really made money there. That's kind of the point, right? One place people have made money is owning assets that benefit from, sorry about that, from owning assets that benefits from rates rolling over, right? And so the history of interest rates in this country is, from the early 80s, dropping like a rock with, unlike a rock, it bounces, right? Kind of like the golf ball bouncing down a staircase, right? The concrete staircase that the stock market's following. That's more or less what interest rates have done since the 1980s, up until, because we never really had inflation, right? Up until COVID. So point is, I don't know what happens. Nobody really knows what happens. But to me, there's really a case here that this inflation potentially, quote unquote, putting my Jeff Snyder hat on, what if inflation rolls over? What if interest rates make their way back to where they belong, which is back on that 40-year trodden path of lower and lower and lower? Because as an asset owner, that would be great, right? As somebody that benefits from that lower discount rate. So my question is, so back to our sheet here, probably not mortgage REITs, triple nets and housing, those both do also like rates coming back down. Triple nets, maybe what can, are what's something to think about when I'm looking at the world of triple nets for investment ideas?
Yeah.
Two I identified were realty income and in one we talked about was IIPR. That's got its own specific risk. Let's maybe go to that later. But just so triple nets. What are things you kind of keep in mind if you were going to invest in a triple net, long or short?
Sure. I think realty income is the perfect example to talk about. At its core, the triple net lease businesses are spread investing businesses. So the entity itself, the aggregate of all the cash flows it receives, the unsecured debt on its balance sheet, the monthly payout to its shareholders, what it's trying to do is arbitrage a private market cost of capital to provide exit liquidity for business owners who happen to have real estate, right? If you are a small franchisee of a business, you've invested your capital into the restaurant business, into the whatever business you have. And maybe, in many places in the country, maybe you bought that building. And so you find that over time, businesses have value that's locked in real estate where they could get more juice by unlocking that cash for working capital to grow their underlying business. The irony is it turns out that the value of the real estate in most cases is worth more than the business itself. Right. For all the reasons we've talked about, right? The multiple on that rent, the capital market financing for that business, for the real estate versus the underlying business, which could be for a small medium enterprise, could be 1 or 2 times revenues. Who knows, right? That just the solvency risk. So at the institutional level, what these capital providers like Realty Income and NNN have done is they've gone out to mom and pops and said, hey, you've got a great little gas station chain here in the Southeast. You've created a nice portfolio of 50 convenience stores. You got some gas stations. Let's unlock that money. I want to write you a check. It's like, I want to write you a check for, let's say, 15 times or 12 times the value of what I consider to be an appropriate rent for this real estate. So you're creating that cap rate. And what we found is that for decades, the private market for these 1031 sale leasebacks or these different types of transactions has been anywhere from like 8 to 10%. So it was a very sticky, basically 10 to 12 times earnings, if you will, right, for the private owner. And so they're able to generate a high single digit or even double digit yield in some cases, these REITs, and then finance it at a much lower rate. Because if I have one Subway restaurant and you're paying me a rent that's after you pay your expenses, your employees, your business, you're basically paying me all of the economics of the residual. And I consider that to be rent, and I'm paying you a multiple up front so I can take that off your hands. I would then go back and finance it. If I had a thousand of these McDonald's, a thousand Subways, from a creditor perspective, my cash flow that I'm spitting out is much more secure than yours, right? Because you only own one. So these businesses at the fundamental level have been able to spread invest, where they would go out and acquire consistently every year um, at a cash flow spread well in excess of their cost of capital. So it made sense, both when interest rates were declining in the public market via, let's say, the 10-year, that the private market did not benefit from a lot of that cap rate compression because of the illiquidity, because of the sizing and all the different things we talked about. When the 10-year went from 6% to 2%, the mom and pop guy wasn't getting 4% financing. Maybe the mom and pop went from 16% to maybe 12%, which is still something. But in terms of magnitude, you can see how going from, as a public company, going from a 6% cost of capital to a 3% cost of capital, that's like you've just cut your debt costs in half, right? And what are the public shareholders willing to pay as a percentage of the multiple and all that stuff? So like a lot of these benefits accrued to the public companies, and whether the markets are going up or down, they have the business is pretty intact. And in fact, just one last thing I'll say, and I'll on the some of the underlying fundamentals is there's a term called the recapture ratio. So when you have a triple net lease building, you typically have these 20 or 30-year leases. They're way out in front. You don't even know if the business is going to be around, right?
Right.
Maybe they're escalators. Maybe it's a flat lease. What people have been able to demonstrate in the better allocators that don't pay up for the yield, because we talked about you can charge a lower rent and you get a lower yield as a landlord, but you have a bigger margin of safety to the credit, to the tenant. Or you can really try to juice that yield and extract a lot of rent, but then if something happens to the tenant, your lease is no good. Right. So the best operators have had a recapture rate north of 100%. So after extracting all this rent from the operator, even in 30 years time, when it's time to relet the space, they've been able to make money on the real estate. Now, a lot of that has been the bond market, right? Because real estate has generally skyrocketed across the country over the last 30 years everywhere. But so I would say if interest rates are rising, on the margin, it hurts the public company's cost of capital, and maybe, but on a relative basis, maybe it hurts the private market guys even more, right? Because maybe when interest rates were zero, they were finding portfolio transactions at a 6 or 7, and the companies were trading at a 4%. We're talking percents, but now the company is trading at a 5 or a 6, but the private market is either completely liquid or it's blown back out north of a 10. So the spread for the public REIT is still accretive to the shareholders. So it's kind of an all-weather type of steady Eddie type of spread investing business. Now, to the public shareholders, we talked about just how powerful cap rate compression is as we get to the low single digits. For someone speculating on capital appreciation, clearly as interest rates either back down or they break out of our zero interest rate policy, um, the public equities will be a lot more sensitive than the underlying business, which in some ways is the antithesis of mortgage REITs, because like mortgage REITs have the public market volatility, but their underlying business is doubly levered
Hmm.
to the cost of because a lot of the times the cost of financing is related to the underlying quality of the business. So when we talk about the structural impairments in commercial real estate, and we talk about, interest rate volatility and B REIT not taking its mark and people not wanting to transact, there are multiple layers of of illiquidity. Whereas at least for the market, that these public net lease REITs trade, there's always a handful every year, right? Mom and pop convenience stores, gas stations, drive-bys, different types of small time real estate that is looking to get its value unlocked for other things.
There's a lot of really good info in there. And so and then one thing you said, I think that really was interesting and encouraging, and thing I latched onto was basically the take advantage. You could take it if you got to know. I mean, so here's two things. One, that chart looks totally, again, this thing pays a dividend. I went to the shareholder meeting. I talked to a guy who's been, he's got a few thousand shares, but he's like, well, the guy's been living on the dividend for years, right? And the dividends, they've raised a dividend, I think, every year they've been a public company. It's not a huge dividend. I think it's a little over 4% right now, 4.5%. Actually, no, it's right at about 5, I believe, right now. But
wow.
Well, let's
double check. There have been periods where it was at 2%.
Yeah,
the stock
right.
went up so much.
Right. Let's double check that number. But the point is that chart looks totally, it's the opposite of these mortgage REITs. Right now, it's a much lower dividend. But the point is, not incorporating the dividend, these guys have created wealth for 30 years, right?
30, 40, 50 years. Tom Lewis.
Dividend yield's 4.4. Oh, sorry to cut you off. Yeah, Tom Lewis.
He's retired from the company.
Yeah.
But he's been around for the many decades. This chart goes back to the 70s.
Yeah.
This is one of those, you can go to all, and it'll have the time series going back to, I believe, 1974. Wow. But it's when you have a $1.
Yeah.
And this is just a modern REIT era. I guess this table goes to 1995, but this company's been around for many years before that.
For sure. And so point one, I like that it's created wealth. Point two, I like that it's a very simple business model. And to your point, the volatility created in the financial markets, you could potentially use to your advantage, potentially, right? If you felt like if you got comfortable with the underlying, and you could buy when it dips if it was not if there's not like an economic reason for the dip. Easier said than done, but you could maybe use some of that volatility to your advantage. So I like that. What about the idea that one thing you hear people talk about with triple nets, but especially like something like realty income. But back to Turtle's big question here, right? Like, okay, if rates roll over, I think we'll do well, right? I think the investment should do well. It should be a tailwind. One concern for longer term, maybe specific to realty income, so maybe you haven't been looking at it as close recently, is people talk about they're kind of running out of real estate to buy, right? And so they've expanded. They went over to Europe a little bit. They're buying like grocery stores in Europe or something. But and so, I mean, now, first of all, I'm sure there's more real estate to buy. There's a lot of people that own real estate. So if that's the biggest headwind for facing the company, that sounds like a pretty good deal. But do you have thoughts on that specific, that seems like if you have to reach lower and lower, essentially, maybe there's not as much low-hanging fruit. So if you have to reach higher in the tree, less ripe fruit, that could eventually lead to some issues. I don't know if you have thoughts on that.
Yeah, this issue is actually pretty well known and documented in the institutional community. So I won't say that this is new news.
Yeah.
But when you look at just spread investing as a whole, what I like to look at, and what you would look at if you were a business owner, is how accretive, one, percentage accretion, but also two, on a per share basis. And what that means is a small company that can spread invest. If you are a $500 million company and you can grow 20% a year, so you acquire 100 million in new properties, right, off of a small base,
Mm-hmm.
you're expanding your base by 20% at, if your blended cost of capital was 5% and you were buying only $100 million worth, and you can find opportunities at 9%, just think about the accretion. That's 80% on your 5% cost of capital. You're adding 20% of the company at, you know, the inverse of that multiple. So you're trading at 20 times, right? Yeah, for simplicity, you are a $500 million market cap company trading at 20 times your unlevered cash flow, and you just added another $100 million. You expanded your company by 20%, and you bought something for 11 times. That's classic spread investing.
Yeah.
And now that you're $600 million, your creditors see you as a larger company with more cash flow, with more resilience, more scale, and your cost of capital then goes even lower, even though you've acquired very accretively. When you get to realty income size today, there's two main considerations. So one, a lot of the traditional net lease companies or net lease structures were for 20-year leases, 30-year leases with a lot of renewables. So apologize, you get all these sounds coming into the box.
It's
But
good. It's money
so
being, might as well be cha-ching, cha-ching. Deals
someone's,
closing.
yeah, exactly. Deal's closing. So there's a duration component to that. And one of the selling features for fixed income investors, as well as for just that steady Eddie mindset, is that, hey, we have these rents in place for 20, 30 years. We're just going to collect every month, every quarter, right? But as the company has gotten bigger, it's had to branch out into other larger portfolios, right? It's like not so much small fish. They've gotten slightly more into industrial, slightly more into these other bigger leases, because when you're $5 billion, if you want to grow 20% externally, you got to find $1 billion to acquire.
Mm-hmm.
So the opportunity set is more limited and much more likely, so that when you're looking at larger portfolios, there's going to be more institutional interest. So that 9% cap rate is probably going to a 6 or 7. It's very competitively bid. And not only are basically there's kind of an indifference curve that you can analyze, and like, how much accretion do you need versus how much volume do you need to create the same value add per share. So you can buy $1 billion of property, but if you're creating, let's say, only 20% accretion, if you're trading at a 5 and you buy at a 6, you might create the same value as just buying 100 million, doing 1/10 of the business, but having much, much more attractive economics, right, to the underlying. So you can see how these larger companies are now in a conundrum where, as they've gotten bigger, they either have to acquire more and more and let down their underwriting standards, or say we're not growing externally, in which case the public shareholders say, why are we going to give you this premium cost of capital if you're not going to take advantage and do the spread investing?
Yeah.
So, and once you get to that size and you're getting into these subsectors that have shorter term leases,
Mm-hmm.
office 5 years, 10 years, industrials 3 years even. So when you have more duration risk,
Mm-hmm. Mm-hmm.
it's a risk to the cash flow, right? So like the weighted average lease term of the portfolio
Mm-hmm.
declines. And again, when you talk about bad actors in the sector, for the purposes of these type of sale leasebacks, you had a lot of aggressive people willing to pay the landlord a lot of money up front, and say, hey, we're going to give you a higher multiple, or we're going to juice our yield to you somehow. but then they wouldn't be able to turn it over to the next tenant. So if that landlord vacated, or if that tenant vacated, they couldn't relet it at the same rate. So all in all, basically the risk profile of the company changes because they have shorter term leases. So you're thinking maybe in a downturn, I'm more cyclically sensitive because I'm reletting properties into a downturn versus saying, hey, I have a 20-year weighted lease term average. It doesn't matter what happens in 1 year. I'm going to keep collecting at the portfolio level, right?
Right.
So there's a composition change in the type of deals that they have to look at, in the lease length of the deals, as well as in the credit quality. And so that offsets some of the inherent attractiveness that is this accretion model from the spread investing.
Wow. No, that's a really well put. There's a lot of information you just conveyed to
Sure,
me
for sure.
in a short, but in a good way. I mean, that's something that I think if you don't, if you've never seen these transactions up front, it's there's a lot of there's some moving parts. I shouldn't even say a lot of moving parts because it's a pretty straightforward transaction, but clearly
You see, even in the slide,
yeah,
it says initial length of lease more than 10 years. The realty income used to put at least like 15 or 16 because they had such a margin of safety. Their weighted average lease term was like 17 years. And they would talk about how, not as stable as all these other companies were. But obviously, as they've acquired and they've grown more, their weighted average lease term has come in.
Right. And back to our, back to our mountain charts, the Mount Fuji's, that all the various Mount Fuji charts. Mount Fuji chart is Dr. Jin, TM, but it's like the any chart that kind of looks like Tesla, TSLA, right? Or ARC, or any of the stuff that blew off during. Whoops, that's not Tesla. That's a stock that probably caught it, but that's there was a Mount Fuji there. And so point being, like, anything looks like this. And again, remember, I mean, the 10-year kind of has that. It's starting to look like it might end up being.
I'm starting to see some support levels. When I zoom out over multiple years, we'll see. It's definitely gotten bearish trade over the last stretch, but I'm gonna look at this level very closely. The 350 level is interesting, but definitely that 316 level, right? We're gonna see, particularly as the year plays out. Can you imagine the 10-year being at 316 and the front end being at 5.25?
Oh man, that would be beautiful.
That'd be a doozy.
Yeah.
But something's got to give, right? We'll have to see how that works.
Right. And so, if the 10-year becomes the next Mount Fuji, which is a huge, massive if that has implications across the world, the point is that that would basically mean, well, here's a Mount Fuji TIP, right? Tips. Here's inflation more. Well, here's the market for tips for the iShare TIP ETF at least, collapsing since the end of 2021, and the point here, what I'm just getting at is that, like, that's an interesting tailwind for something like realty income. Like you said, these 20-year leases, like, runaway inflation's a real problem, right? For a 20-year lease or for a long duration lease. And some of that appears to potentially be.
It's funny because as all thematics aside, when you look at the tips chart, when you look at break evens, it would seem that the bond guys have sniffed all that out already. Right. That at least for the foreseeable future, especially if 23 comes to pass the way we think it might come, that there's going to be a lot more deflationary forces at play than inflationary ones. But we'll see.
Yeah, we will see. Right. So thanks for that. So back to my chart. I mean, I think that's a lot today. We talked a lot about EQR and apartments last time. Actually, I did like a 8-minute video yesterday on an EQR. I bought it. It broke out above a trend line, and so that was the extra thing I needed to get long of it. So we're long some EQR in a couple of different accounts. And yeah, so cool. Thanks for that. That was super helpful. Anything else you want to close it out on? And thanks for another episode of
Um,
Assets with Jimmy.
and that's all I got right now. I think the next couple of weeks are going to be quite interesting. We're digesting a lot of earnings. We are digesting some perhaps rosy 23 outlooks.
Yeah.
It's two things because someone can be very measured on the call, talk about cautious optimism, acknowledge the various breaking points, but this is true since the very beginning of time. The CFO, you can't say we're going to lose 10% year over year, 15% year over year, even if the internal numbers in your business show that. As far as providing initial guidance, there's definitely gamesmanship. It's not like revising guidance to beat it over time, especially in these periods where you're coming at the end of a business cycle. um, when someone says we're going to grow low to mid single digits, that is the nomenclature. Okay, that is the euphemism to say that our business momentum is stalled and we're going to, our visibility has very, very much narrowed. So it also would not surprise me to see us come out of this earnings season relatively unscathed. We're absorbing all the FUD, all the bearish narratives, only for us to come into the year in May and for these companies to start either cutting guidance again or to acknowledge the passing reality of what's transpired. And maybe we are we're buoyant for a month or two, and then come in the spring we have another spill, if you will, when new layers of reality are being digested and incorporated into the market. But the trading action over the last 2 weeks. I mean, we were in the lows at the end of December. Here we are a couple weeks later, and people are ready for inflection points for the pivot. Where S&P is hanging out north of 4,000, and it's we're talking about Qs at 300. So
we're breaking out. Yeah, we're breaking about
we're
above
breaking
one.
out.
Yeah.
Famous
No,
last
that's
words.
yeah. No. Thanks for your time, Jimmy. Great stuff. I couldn't, no, I'm excited to kind of see how this plays out over the coming weeks. And to your point, look, I mean, I would love to go in another bull market. I'd love things to break out. But to your point, it's like
I need it. I need the bull market.
But right. But I'm trying not to need it. Yeah, exactly. And that's all we're trying to do here. Is just not need anything.
That's right.
I don't. And on Twitter, people are very vocal, and they're perma. They're a lot of perma. They're perma one thing or the other. And I don't think that's how you make a lot of money, right? Like I think maybe you can make money just trying to just take an even keel. Look for a fat pitch, right? Look for something that's or something like triple nets. It's a simple business model to understand. They've been kind of trending up for many years, generations. It wouldn't, that trend line breaking would be a big deal if true, right? Maybe taking advantage of any deviations from the trend might, so the point is that, looking, trying to look for opportunities as opposed to trying to be right. That's all I'm trying to say. So
for sure.
Anyway, with that, Jimmy, thanks for your time. Let's talk very soon, and we'll be back. Thanks for listening to episode 3 of Real Assets with Jimmy. Have a great rest of your day.